As we approach 2025, investors are navigating a challenging yet dynamic economic landscape. The Nifty has recently corrected nearly 10% from its September 2024 highs, reflecting heightened market volatility and cautious investor sentiment. This pullback raises questions about whether this is a short-term correction or the start of a broader trend. In addition, with Trump's re-election, the recession in the West, the war scenario, and multiple other things, the global and domestic macroeconomic environment continues to evolve with geopolitical shifts, technological disruptions, and structural reforms shaping market movements. For sophisticated and high net worth individuals and institutions, understanding these trends and positioning their portfolios for growth opportunities while managing risks is more important now than ever. This panel brings together three of India's most respected industry veterans, each with extensive experience in navigating market cycles, identifying turning points, and driving successful investment outcomes. Their insights will provide a forward-looking perspective on where the Indian markets and economy are headed in 2025 and beyond, helping investors decode the next big opportunities. Ladies and gentlemen, our panelists are Mr. Sunil Singhania, founder of Abacus Asset Management. Mr. Singhania is a pioneer in the Indian asset management industry with a career spanning decades. As the founder of Abacus Asset Management, he has established a formidable platform for India-focused investments, and prior to this, he held leadership roles at Reliance Mutual Fund, where he managed one of India's most successful equity funds. A global thought leader, he was the first Indian to serve on the global board of the CFA Institute and has made significant contributions to advancing professional standards in investment management. His ability to identify trends and deliver exceptional returns has cemented his reputation as one of the country's top fund managers. We also have with us Mr. Raamdeo Agrawal, Chairman and co-founder Motilal Oswal Financial Services Limited, an awardee of Rashtriya Samman Patra by the Central Board of Direct Taxes. Mr. Raamdeo Agrawal is the chairman of Motilal Oswal Financial Services Limited and the driving force behind the company's approach to investing. Mr. Agrawal has created the QGLP, Quality Growth Longevity and Favorable Price Investment Process, and its buy right, sit tight investing philosophy. Mr. Agrawal is also the driving force behind the MOFSL Group's highly awarded research. He has been authoring the annual Motilal Oswal Wealth Creation Study since its inception in 1996. An associate of Institute of Chartered Accountants of India and a member of the National Committee on Capital Markets of the Confederation of Indian Industry, he has also been featured on Wizards of Dalal Street on CNBC TV 18. And our final panelist is Mr. Vikas Khemani, founder and fund manager, Carnelian Asset Management and Advisors Private Limited. And with Carnelian Asset Management and Advisors Private Limited, ladies and gentlemen, he is a stalwart in India's capital markets. Mr. Vikas brings 23 years of experience, including his tenure as CEO of Edelweiss Securities Limited, where he built industry-leading businesses in institutional equities and research. As the founder of Carnelian Asset Management, he leverages his vast network, deep market insights, and strong relationships with corporate India to identify and capitalize on high-growth opportunities. He's an active member of the industry bodies such as CII and FICCI. He's also a recipient of the ICAI's Young Professional Achievers Award. Mr. Vikas Khemani's strategic mindset and understanding of macro trends make him a highly sought-after thought leader in the investment community. And this absolutely power-packed session will be moderated by Mr. Kamal Manocha, who is the founder and CEO of PMS AIF World, where he leads both wealth management and content initiatives with a strong focus on research-driven investing. It is under his visionary leadership the firm has introduced several innovative investment frameworks, the last being the Quality, Risk and Consistency model, designed to provide deeper insights into portfolio management services. PMS AIF World serves 600 plus high net worth clients, managing assets worth rupees 1,700 crore plus, reflecting its strong commitment to delivering quality investment services. With 20 years of experience in the financial industry, Mr. Kamal Manocha has consistently driven strategic growth and thought leadership in the investment space. He holds a master's degree in management and an honors in economics, along with multiple prestigious investment certifications. Mr. Kamal Manocha, the stage is all yours to guide this esteemed panel in an engaging discussion on what lies ahead for investors in 2025 and beyond. Take it away, sir.
Thanks, Aishwarya. Thank you for such an, I would say, elaborate start to this session. And I'm really honored to be moderating this panel every year. We do this crystal gazing summit, and the objective is very sincere. We want to handhold our clients by providing them clarity, conviction, and confidence. And times like present where markets are going through correction, reinforcing the confidence of our clients and investor ecosystem is very important. And that is where I really thank Raamdeo ji and Sunil ji and Vikas for joining for this particular panel. We want to understand, way ahead. So, first question to you, Sunil. We are decoding the next bull run. We have kept the topic optimistic, and by nature we are optimistic. In India we are seeing reforms, and we have seen articles written in the past by eminent Raamdeo ji that Sensex is heading to 2 lakh. But this is a time to kind of maybe verify and kind of understand, and yes, kind of deep code. So are we really in a bull run, or is this a beginning of something which is like bothering you as well?
Thanks a lot for having me, Kamal, and Aishwarya, thanks a lot for making me feel so good by this elaborate introduction. But you're right. I think we have been in the midst of a challenging time period. And in fact, the challenging time period has been going on for the last 9 months. But obviously, because of various reasons, optimism from all of us, flows, and so on and so forth, I think the broader markets were sort of sustaining itself. It's only in the last 45 days that we have seen a real correction, particularly in the broader markets. Having said that, it's not the first time we have seen this kind of correction. I think over the last so many years and decades, corrections have kept on coming. I think the only difference this time is that normally corrections in the markets will have time correction and price correction, and both. When there is a time correction, obviously, the pain is not as much. When there is price correction, which happened during COVID, but the time horizon is not very long. You suddenly have a sharp dip and then you bounce back. I think this time it has been both a time as well as price correction. And at least my view is that this time correction might continue for some time. And the reasons are as follows. Normally what happens is when you have 9-10 months of market correction, in those 9-10 months, companies have normally built in another 10-15% of additional profit growth. And therefore, you have a 10-15% price correction and then 10-12% profit growth. And therefore, the correction technically becomes 25-30%. This time, there has been a price correction, but unfortunately, profit growth, particularly in the September quarter, was very poor. And in December quarter has been just marginally better. And therefore, with the same time correction and the same price correction, we are still the valuation. And to that extent, even now, when you look at the broader markets, I think stocks, I would not say all the stocks, but quite a few stocks are still trading at a premium to their long-term averages. And therefore, being always an optimistic, and I do believe that India will grow from 4 trillion to 7-8 trillion to maybe further. And, investors will make a lot of wealth over the long term. I think we still believe that this is going to be more a W-shaped recovery rather than a V-shaped recovery, where you'll have some, pullback on the upside, maybe some correction, and then again, slowly it will inch up. All we need, obviously, is earnings growth. And now we'll have to wait for the March quarter for that elusive earnings growth to come. And I think if that comes, then maybe the time correction also will get, fulfilled.
Sure, Sunil. Raamdeo ji, how do you assess and see the current year 2025? We have seen last 8 years, equity markets in India have consistently given positive returns. How do you decode 2025 and the current correction, at the way it is going on? What are your views, given your last 30 years of illustrious experience?
Yeah, this time, so what Sunil said is right. But this time the difference is that it is happening with sustained inflow. At least till January it is there, maybe in February also. So in the past, the retail participation was not taken for granted. But the flow of about 45-50,000 crores per month, it may come down to maybe 35-40,000. So that only time will tell how much flow continues. But things are correcting while flow is on. So the sellers who are the sellers? The sellers are FIs to some extent. Your promoters are selling and IPOs are coming. Private equity, everybody is selling. So the selling is now coming. About a year back, only FIs were selling a little bit, but the primary market was not that active. But last 1 year has been bumper primary market. So now supply has caught up with the demand. So it is no more that because there is a flow, and hence market will remain up. And particularly in the mid and small, at any price is the right price, and it was going up. So that phase is over now because there is enough supply from the promoters themselves. I mean, in those stocks, promoters themselves are willing to sell. QIP is happening, IPO is happening. So there is an IPO machine is so big that they are saying that, okay, if these three companies are trading in mid cap range at say 35p, I am willing to offer at 25p. So they are also bringing out the table continuously. So there is a supply and demand has matched now, and probably maybe supply is a little more than demand right now. And that's why market is corrected, which is, I would say it is healthy so far. It has not become unhealthy. I mean, if you look at the large cap, in large cap damage is not that much. The damage is actually in the mid and small, where money made was also too much. I mean, if you see the last 12 months performance, some of the stocks were crazy. I mean, so clearly there is a correction in those stocks where it was excessively pushed up. So I would think this is a very healthy correction, and markets are, I mean, even at 21, 22 times, I think market is giving a good valuation to us. Now, in my mind, the only point is how will this correction stop? What are the forces which will, kind of create some kind of bottom? Because it can't go to zero or something like that. I mean, like from 23,000, is 23,000 bottom, is 22,000 bottom? And I don't think it is about the absolute number. It is about what are the forces, what will change of these 4-5 things. Either supply is going to change, or earnings are going to come up, or demand is going to increase. So all these things will happen at lower prices. Maybe promoters will stop selling. Maybe IPOs will stop. Even FIs at some point of time, they'll say, we'll want to buy. Instead of at 21p, they're not coming in, but 1920p, they can. So all the four factors, which is supply side, can become demand side. And in any case, the domestic investors are buying. So something will change. But right now, it looks that supply is more than demand, and hence correction is happening very in a methodical fashion. And at times it is giving jitters. Like today, I was getting some calls from some people they are concerned. And the problem is that out of 190 million demat account, 140, 150 million are less than 4-5 years. They have come post-COVID. They have not seen corrections. So for them, it is a lot more unsettling. So that is also a factor. There may not be, there is quite possible that the whole lot may become a little more concerned. So let's see. I mean, it's I would say a little concerning time for the investors at large. For me, I have seen a lot of markets. Sunil has seen a lot of public markets, So I think it's a good panel to discuss how things may shape up. See, nobody knows how things will shape up. But one can visualize, looking at the variables, at what level promoters will stop, at what level IPOs will not happen. Because we are seeing bankers are bidding, say, 20,000 crores. At 10,000 crores also now IPOs are not happening. So now trouble is shaping up even in IPO market. So at what level IPO machine will stop, that also one has to see. So I think it's a very dynamic situation. It will be, but markets are expanding. See, size of the market is expanding. More IPOs happening, more QIPs happening, promoters holding is coming down, FI holding is coming down. There's a lot of activity in the market. So that's positive. But right now, I think we are in corrective phase.
Sure, Raamdeo. Because you have always been a proponent of, Bharat Amrit Kal, and we are obviously all believers of the same. And within that, you have had a very successful run up in the shift, discovery, whereby Indian economy did see and demonstrated a structural shift towards manufacturing. But after the recent, deglobalization, I would say fear around the world, from Trump coming in, and he kind of expected to announce a lot of tariffs, whereby if tariffs announced on China, then China could dump manufacturing products to India, and it could impact Indian manufacturing. So that would derail the entire, I would say, Bharat Amrit Kal scenario. So how do you see this entire present time, in this context?
Thank you, Kamal, for inviting me on this August panel. So I think, see, in every market, every economy, we have seen this for a very long time, last 20 years, 30 years. I think many corrections have come, many such periods comes. I mean, from immediate memory, this time reminds me of, in some sense, Jan Feb of 22, when Ukraine war had started. We were, market recovered. 21 was a great year. A lot of money was made, and then, Ukraine war started, and suddenly global fears, inflation fears, and, and market corrected from almost 18,000 Nifty of to 15,000. And around that 6 months period, everybody, who was turning bullish in 21 kind of started questioning and India story and, what can happen and all. So whenever markets correct, very natural thing is to start questioning long-term India story. But we all know from experience that India story is not a short-term story. So and people who invested in the time of that, vintage of Jan to June 22, today also after correction also are sitting on a very, very large handsome gain, right? So it is in the times of uncertainty where you need to hold on to your nerve, and you need to have conviction that India story is a very long term story. I mean, in last 20 years, if I were to go, Nifty has moved from 800 points to 23,000 points, and in this period, all kinds of, uncertainties have come. Governments have changed. Global financial crisis happened. Many scams happened. Fragile 5 happened. ILFS crisis happened. GST, demonetization, Ukraine war, pandemic, everything happened, right? But the fact of the matter is the underlying strength of the economy today, underlying strength of our whole nation and the economy is so robust. We have grown from $250 billion to almost close to $4 trillion. This number in Amritkal will go to $30 trillion. It will happen in this period, like we have had many past corrections and consolidation, both at the economic as well as market levels, will continue to happen in times to come. Investors have to understand that every time something like this happens, we don't question India's story. Today, if you see, risk is far more talked about the potential. Last year, nobody wanted to talk about risk. Everybody, like Raamdeo was saying that, fancy valuations, everybody wanted to, go IPO. And, so markets will have these kind of phases and will continue to have these phases. My conviction is that there are not many structural weaknesses in our economy. Our corporates are not leveraged. Government is not leveraged. Our fiscal is in control. Current account deficit is in control. Our banking system is solid. Our inflation is under control. Our, forex reserves are under control. So, there are no structural fault lines in the economy which typically drive deep corrections in the market. So those deep corrections are out, in my opinion, not a possibility. 5, 10, 15% correction are par for the course, normal in any market. And today, like Raamdeo was saying, market has given a very good reality check. The excesses which got built in last 6, 8, 9 months have got corrected. Promoters who were looking to raise capital at any fancy valuations have been given a reality check. I think, and I think this is very good news. I mean, as a manager, I think this is a great time to receive money to kind of invest, because like 22 vintage delivered great returns. I have zero doubt in my mind that this vintage of first half of 25, if we were to do a call 2 years later, we will talk about this and say this vintage was a great vintage to kind of have invested, because many mid and small cap stocks have corrected 40%, 50%. Many IPO companies have corrected 40%, 50% from their prices. Same great companies, but valuations are great, right? So I would say that I am not at all worried from a long-term perspective. Medium term, anybody's guess. I think, like I completely agree with Sunil, that it might not be a quick recovery. It might require some bit of a time consolidation. But again, these are the times where, rather than getting scared, to redouble your conviction is the more important thing.
Right, Vikas, we are absolutely, I would say, confident, and at the same time, it is our responsibility to help investors make, well-informed decisions, and that is the context. And we want to be realistic in our expectations, and that is where, we all understand that yes, 2025 may not be, same like the past years that we have seen, and it is a time to take a pause and kind of understand where we are headed. So moving on to you, Sunil, I have been kind of moderating almost all top fund managers, and I have seen another fund manager, very well known name, Mr. Samir Arora, who always says that in long term, Nifty 50 and Nifty 500 returns are always alike. It's like 10-year period. Ultimately, you invest in large caps or you invest in a basket of mid and small caps. you ultimately end up getting similar returns like long-term averages of 14-15%. Why to get into mid and small cap kind of a fund, and ultimately have so much pain? Because 80% companies eventually end up giving bad returns, and the average at a fund level ultimately is same. But you are a fund manager who is mid and small cap focused fund manager, and that is where I understand that at stock levels returns are good. But from the point of view of investors, when they invest money in portfolios which are like 5,000 crore plus assets and are invested in mid and small cap oriented companies for long term wealth creation, how do you give them a perspective when we see such times and one is reminded of such wisdom that yes, ultimately long term returns are same? Why to get into mid and small caps?
So a few things. One is we do invest across market caps. Obviously, I think the interest and we're known for, I would say, broader market investment because, the whole focus from our side is in-house research and trying to find companies which are not normally widely tracked. Having said that, I think, at the index level, Nifty 50 and BSE 500 are not the true indicators because there is almost a 95-96% correlation between them. I'll just take the example of two funds which were very popular in my earlier avatar at Reliance, Reliance Growth Fund and Reliance Vision Fund. They were very, very well known. Both started at the same time. The NAV of Reliance Growth Fund has grown to 4,000 from 10 in like 31 years. The NAV of Vision Fund is 1,300 in the same time frame. Now, Vision was focused on large cap and growth was focused on mid and small cap. So I don't think it is right to say that the returns have converged. I think the indices taken are very different. The other thing is when you are doing broader market investment, it is not the index. You are looking at companies which can grow faster. And as I said, where, the coverage is not that much and therefore there is some, you can say, differentiation you can add. See, ultimately market price is equal to EPS into P. EPS earning P is perception. When you invest in a broader market company, normally the perception is much lower than an established company. And the EPS growth is faster. And when you have both EPS as well as P growing, you end up making slightly higher returns. Now, India is a country of entrepreneurship. India is also a country of various sectors, upcoming sectors, new sectors. All the so-called large caps at some point of time were startup businesses, including the recent, the Dixons of the world and so many other companies, or Varun Beverages, who started very small and have now become large caps. So I would say that as long as you are entering into a company from a view of obviously some time frame, 3-4 years, faster growing, and at the same time trading at discount to the larger bets, I think there is differential return to be made. So we always say this, large caps are like elephant. It is very difficult to topple them, but they will have their own pace of growth. And mid and small cap would be obviously like maybe tigers or some other fast moving animals where there will be more volatility, but when they move, they will move fast. So I think in Indian context, it makes sense to not ignore the broader markets. From an investor perspective, I think investors have to take their call in terms of asset allocation. If you are okay with a longer time frame and willing to bear the volatility, then obviously I think the broader markets will do very well. But if you want stability, you have to have large cap. And if you want both, then maybe a diversified approach or a proper asset allocation is what is needed. But I would disagree that returns converge. They have not converged last 15, 20 years, and at least for the next 5, 10 years, barring this short-term, phenomena which we are seeing right now, it will happen. Hey, Kamal, what happens, we are swayed by recency bias. If recently something has worked, we believe that it will work forever. If recently something has not worked, we will believe that it will not work forever. So last year, we were very aggressively telling our investors that please avoid mid and small cap fund of ours and invest more in a flexi approach. But because of the recency bias, they were not willing to listen. And now I'm very sure even if you tell them that please invest in mid and small cap, because of the recency bias, investors will prefer the large cap. So I think we are all human beings, and these are characteristics which we cannot get away with. But I think in India, I would disagree, and I would say that there is merit in expecting higher returns in the broader markets.
Sure, Sunil, well put. Moving on to Ramdevji, I have been reading off late your articles, and I have been getting this feeling that you have this conviction that the next bull run will be giving a lot of significance to some of the bruised large cap companies. You have mentioned that in a couple of articles. I read that, and I'm talking about stocks like Asian Paints, which we used to call as compounders at some point of time. Obviously, we have forgotten them because they have not participated in the last rally. What are your views? We are wanting to kind of see way ahead and decoding the next bull run from here onwards. And what are your views in this regards?
Yeah, so there was a study, last valuation study about the blue chips. And clearly, these kind of markets, they throw some of them, I mean, as the correction deepens, you'll find some of the overvaluation in the blue chips, particularly not such a big ones, but next Nifty, next 50, and between 50 to 150 kind of a ranking companies. So there will be, I'm sure, some companies will get bruised, and the corrections will be quite deep, and particularly the growth companies, the corrections will be even deeper because they also move high beta stocks, so they move big time. I mean, 10% market moves up and they move by 30-40%. So on 10% decline, they'll also fall by quite significantly. So clearly, this will give opportunity to the people who understand the value of the companies. One of the things which I think is going to happen is that the risk capital flow in the economy has increased significantly, and it's permanent feature in the sense that the participation of retail, which was not there earlier in about 2020, you had only 40 million total demat accounts. That is duplicate, or if 50% was duplicate, in that case, you had only 20 million demat accounts. I mean, it looks unbelievable that you had only 20 million demat accounts which were operating. Today, you are talking about 190 million. I don't know how much was the duplication. Even if 50% is duplication, you are talking about 20 million going to almost 100 million. So there is an expansion of the market, and that expansion continues. Last month also there is 3 million, 2.8, 2.9 million accounts of demat accounts have opened. So clearly, market is expanding and risk capital flow is increasing. Now, at what this risk capital flow into the new corporates, new entrepreneurship, getting confident about getting money and getting good amount of money. So instead of putting a 5-acre plot, they might go for 50-acre, kind of expansion. So that how this will shape up the corporate world, it will have an impact on the corporate world and corporate earnings as we go forward. Maybe not this year, after a year or so. So that is what really, I mean, now one phase is over. In my mind, post-COVID recovery and whatever happened with the earnings doubled from 450, 500 to 1,000 rupees for the Nifty. So that happened, and we gave the valuations, and whatever happened, one round is done. Now the second round, after this correction, wherever it stops, then the recovery, we have to focus on the recovery. What will do well? And there, I think the corporates which are beneficiary of the capital raise now, and those who have a bright, business prospects, and wherever earnings build up, So, so that's where the focus will be, in the sense that next round focus will be there. And some of the, what you said about the bruised blue chips or busted growth stocks, the second category is busted growth stocks. So what happens is, in the high growth companies, suddenly the IPO happens at 100 rupees, the stock go down to, they go up to 200, 300, and then come down to, half the price and those kind of things. So I think the same framework, again, some large caps will give opportunity to buy in. So actually, I mean, for a person like me, it is an opportunity to watch some of the good companies getting bruised, and can we buy them? We couldn't buy in the past. Can we buy them now? Whether it is a growth company or whether it is whatever you like, or it is a value company, whether it is a growth large cap, say banks are like clearly slaughtered, or they're not made money for last 4-5 years. And in this kind of a downturn, because without banks, you're not going to go anywhere. So clearly, some of the banks will become very attractive to buy. Their valuations are reasonable. They're well-running banks. Their asset books are very clean. So this downturn should be used as an opportunity to pick stocks rather than kind of getting depressed or anything like that. This is a part of the life. It will bottom. When it will happen, I don't know, and why what will force it, that I also don't know. But this can throw some amazing opportunity to look at the values.
Sure, Ramdev ji. Moving on to you, Vikas. As I mentioned in the earlier, question, you have been kind of very intuitive in identifying some of the themes, and your last identification, which is structural shift towards manufacturing, has been phenomenal. After recent budget, I had read, you were mentioning that the consumption sector rally that has happened may not sustain because it's like budget, though seems to be optimistic of consumption, but the earnings will not come soon. And exactly the same happened. Whatever stocks went up during budget day, ultimately the subsequent week, they were all down. What are your kind of views in this regards? As Ramdev ji mentioned, that these are interesting times and a lot of new themes will definitely emerge. What are the next, I would say, drivers, the next themes which you are looking ahead of time in terms of identifying and then kind of adding in your portfolio?
I think, Kamal, first of all, I will say right now, in the recent correction, market is ignoring two or three very interesting policy pivots which has happened. Right? If you see today, I mean, last 6 months, we had a huge shortage of liquidity in the country. RBI was tightening and they were defending rupee, and which kind of created an unintended consequence in terms of slowing of the credit growth, tightening of the liquidity, hardening of the rates. Today, I think, governor has kind of, RBI has released liquidity, given an indication of cutting in the interest rate, right? Which markets are completely ignored. I mean, that's what at least you want when economy is kind of slowing down. Same thing, I think, in the budget. The reduction of the tax rate was a great thing in my opinion. It has, of course, left a lot of money in the hands of the citizens. Now, how they will use it, definitely. I mean, I'm sure that it will not entirely go into consumption, and there can be many debate where it will go. But the point is that at least that much money is there, and it will definitely help, reviving many sort of slow growth, right? So, and also, if you ask me this time, a lot of measures were taken in the budget, which was towards ease of doing business, opening up long pending demands, which were not much talked about. I mean, it's a long discussion, but what I'm saying is that a lot of interesting things are happening right now from policy perspective. But today, and they are all macro, they will have impact 3 to 6 months down the line. So, in my opinion, market is ignoring that all lot of good developments which is happening in the recent correction. And I think this is the time to kind of, capitalize on some of these things. There are medium term themes and long term themes. Long term themes, whether it is manufacturing or consumption, infrastructure, don't change. I think manufacturing, according to me, continues to remain over next 10, 15 years a very big theme, as we've been saying for last 4 years. Whether it is, and within manufacturing, then you can talk about things like CDMO, things like auto components, things like EMS, things like defense, which are again long legs, and then you have to identify your risk reward focused companies specifically. So themes are there. But I think from this year's perspective, I feel last year, banking didn't do well. I think again currently continue to remain weak. But this year, my view is that banking will surprise everyone. Banking will be one of the big winner as this liquidity eases, credit growth picks up. The credit growth which was there in 16, 17% range went to 11% with the liquidity tightening. I think second half of this calendar, probably we will start seeing the pick up on the credit growth, and system liquidity will become easy. Interestingly, by the way, last 1 week, a lot of debt flow has come into the country, foreign debt flow, foreign money has come into the debt. That again tells you that a lot of positive moves are there. Foreign investors are not worried about as a country risk, right? So a lot of these things are there. Now, if I see the structural drivers are player and policy pivots which are happening, they're all positive news. So I think banking will do well, IT will do well. Again, there's no doubt in my mind that there's a reasonably good demand opening up in US and all on the IT side, and we will beneficiary of that. Pharma is doing well, manufacturing doing well. So some of these things continues to, but this year I feel banking will be one of the bigger winner.
Sure, Vikas. Sunilji, do you agree with Vikas' opinion on banking doing well, IT doing well, and manufacturing being a long-term trend, at these levels from here onwards?
So, I'll just like to just point something. So one is, a lot of times sectors do well, but stock prices don't react, and vice versa. So, for example, 2024 was the best year for banking in terms of asset quality and even profit growth, but the stocks did not do anything. And IT had the worst growth in profit, since Lehman time in 2008. But stocks did very, very well. So I think it's all about what your view on the future is. But having said that, I would completely agree on the banking side for few reasons. One is obviously, at least our view is that globally, we are hitting the peak as far as inflation and interest rate is concerned. Now, the joker in the pack is what happens to the tariffs if and when they are imposed, because tariffs will lead to all the expectations on inflation having to be reworked. But taking that out, I think it is very clear that globally now we are looking at interest rates coming off. I would completely agree with Vikas that liquidity scenario is now improving. Little bit, the central bank is also realizing that if they squeeze too much, then there is an impact on growth, which we are already seeing, whether it's the IIP numbers, whether it's the GDP numbers, corporate profit numbers, and so on and so forth. Third is, I think this is the only sector which is trading at a significant discount to its long-term average. And on a PE basis, even large banks still are trading at like sub 15 PE multiple. Smaller banks are trading even lower. So I would agree with that. In fact, if you see Europe, which is supposed to be the worst region in terms of growth, I think the markets are all-time high. And if you see the drivers there, it's predominantly the financials. And I would say that the reason might be, we are not experts, that the view is that interest rates are slowly going to inch down. Manufacturing will always be a good thing. Unfortunately, the valuations are discounting the sky. They were discounting the sky 3 months back. I think now they have just come maybe slightly lower, but they're still significantly at a premium to their intrinsic value. Now, for them to perform from here, profit growth has to be very strong. And unfortunately, September was bad. December also, that sector has disappointed massively. And in themes like defense and railways, we are a little careful because there is only one buyer, which is Government of India. And we saw what happened when the budget for defense was disappointing. All stocks fell 10-20%, and it's a very, very low, I would say, long gestation kind of thing. So while being very positive on manufacturing, we would wait for either valuations to become more thinner or growth to start surprising on the upside. Pharma continues to be a good sector for us, positive. But again, there, I don't know what will happen when the announcements of tariffs on pharma comes. I don't think they will be able to implement it. But markets right now is behaving more on news flow than actual understanding, because I don't think the US can afford not to import generics, because their own costs will go up and there will be massive shortage. So I think it is going to be a very interesting next few months. But a clear, I would say, positive is the banking or the outlook is banking. I don't know whether it will come right or not, but others will have to take it as it comes.
Sure. Thank you, Sunilji. I think it has been really insightful in conversing with all of you. We are like finishing with our time. I will just say, my quick, conclusion to all clients and investors that, everybody here is perennially an equity investor. All of us have our own asset allocation, but, I can tell you that investing in equities is always going to create maximum wealth. And times like these are times to take pause and definitely make, knowledge your friend. Something which is done with understanding converts risk into an opportunity, and that is exactly what we intend to do. And we at PMS AIF World have made knowledge as our weapon, and we don't just say that, we implement that, and that is the power, and that is the kind of, I would say, foundation that we have created. And that is where, year on year we have been doing such phenomenal summits. It's like absolutely, I would say, happening because of such fund managers who also support us in this regards, because it is important to handhold our clients and investors, especially in the journey. Thank you once again, for joining, and thank you everyone for your time. Over to you, Aishwarya.